March 10, 2000. On the trading floors of Wall Street and in the glowing pizza box-strewn offices of Silicon Valley, a new religion had reached its zenith. The NASDAQ Composite Index, the high temple of this new faith, screamed past the once unthinkable barrier of 5,000, a level it wouldn't see again for 15 long, painful years. Day traders, armed with newfound E-Trade accounts, became millionaires between breakfast and lunch, their fortunes built on companies with no profits, no tangible assets, and often no coherent business plan. It was, they called it, the new economy, a world where the old, dusty rules of value and profit, rules that had governed commerce since the time of the Phoenicians, were declared dead, replaced by a new gospel of clicks, eyeballs, and a future of limitless, frictionless growth. And in Omaha, Nebraska, in a modest brick building called Kiewit Plaza, one man looked at this roaring bonfire of speculation and simply did nothing. Warren Buffett, the most successful investor of the 20th century, the man they called the Oracle of Omaha, was being publicly and systematically ridiculed. Financial television, a new and powerful force in itself, buzzed with commentators and fresh-faced analysts who openly mocked him. They called him a dinosaur, a relic from a bygone era of smokestacks and railroads who simply didn't get it. His longtime partner, the brilliant and acerbic Charlie Munger, would later describe their lowly position as being the top of the dunce caps. A prominent financial magazine, Barron, had published a now infamous cover story just a few months earlier, in December of 1999. The cover showed a picture of Buffett with a single, devastating headline. "What's wrong, Warren?" The article questioned, with a tone of genuine concern mixed with condescending pity, if the world's greatest investor had finally lost his touch. It suggested that his old-fashioned methods were now hopelessly obsolete in this new, technologically supercharged world. The pundits laughed at his portfolio of insurance companies, candy makers, and soda brands. They laughed at his stubborn refusal to buy the dot-com stocks that were making everyone else, from their janitors to their dentists, fabulously rich. What they didn't know, what none of the prophets of the new economy could have possibly imagined, was that they were witnessing the final euphoric moments before the greatest financial cataclysm in a generation. Within weeks, their laughter would turn to terror. Their paper fortunes would evaporate into digital dust, and they would discover, in the most brutal way possible, what happens when the timeless mathematics of value collide with an avalanche of pixels and promises. Act 1. The genesis of a mania. To understand the collective madness of the late 1990s, we must first understand the fertile soil in which it grew. The decade began with the fall of the Berlin Wall and the collapse of the Soviet Union. The Cold War, a 45-year drain on global resources and psychology, was over. A sense of triumphalism and boundless optimism swept across America. It was Francis Fukuyama's end of history, and American free market capitalism had unequivocally won. This peace dividend was supposed to unleash a new era of prosperity. Simultaneously, two technological revolutions were converging into a perfect storm. The first was the personal computer. The children who had tinkered with Apple IIs and Commodore 64s in the 1980s were now the young adults entering the workforce, fluent in a digital language their parents barely understood. The second and far more powerful revolution was the birth of the public internet. On August 9, 1995, a small company called Netscape held its initial public offering. Netscape made a web browser, an intuitive graphical interface
that opened up the World Wide Web to millions. The company had never made a profit, yet its IPO was a sensation. Shares priced at $28 opened at $71 and closed at $58. A star was born and the race was on. This technological explosion was doused in financial gasoline by the economic policies of the time. Federal Reserve Chairman Alan Greenspan, despite a famous 1996 speech where he warned of irrational exuberance, kept interest rates relatively low. More importantly, after the 1998 collapse of the massive hedge fund long-term capital management, the Fed orchestrated a bailout, injecting billions into the financial system. This sent a clear message to the market. The Fed would not allow a major failure. This Greenspan put created a sense of a safety net, encouraging even riskier behavior. A new priesthood emerged to preach this new gospel. Figures like Mary Meeker of Morgan Stanley, dubbed the Queen of the Net, published influential must-read reports. Her 1995 Internet Report became the founding document of the boom. Technology visionaries like George Gilder wrote hugely popular books like Telecosm, arguing that the world was on the cusp of infinite bandwidth that would make old business models and old valuation metrics entirely irrelevant. Venture capitalists in Silicon Valley became the new kingmakers. John Doerr of Klein Perkins, who had famously backed Netscape and Amazon, became a legend.
He declared the internet boom was the largest single legal creation of wealth in the history of the planet. Getting a company door-funded was like receiving a royal charter. On Wall Street, a new breed of analyst became famous overnight. Henry Blodgett of Merrill Lynch became a household name when he boldly predicted that Amazon.com, then still just an online bookseller hemorrhaging cash, would hit a price of $400 a share. When it did, he was hailed as a genius. The old metrics, like the price-to-earnings ratio, were dismissed as quaint relics. They were replaced with new, more accommodating metrics, price to eyeballs, network effects, and first-mover advantage. The argument was simple and seductive. In this new digital frontier, you had to spend aggressively to capture territory. Profits were not just unimportant, they were a bad sign. Profits meant you weren't reinvesting enough in growth to become the dominant player in a winner-take-all market. The public, armed with new online brokerage accounts from companies like E-Trade and Ameritrade, dove in head first. The number of American households owning stock more than doubled in the 1990s. The stock market, once the domain of the wealthy, became a national pastime. Taxi drivers traded tips on tech stocks. Magazines like Wired, Red Herring, and the aptly named The Industry Standard became the new Bibles. Stories of secretaries becoming millionaires through their company's IPO were everywhere. It was a gold rush, and no one wanted to be the last one to stake a claim. The initial public offering, or IPO, became the sacrament of this new religion. In 1999 alone, there were 486 IPOs, and 117 of them doubled in price on their very first day of trading. The average first-day pop was nearly 70%.
A company could be founded, burn through tens of millions in venture capital, and then go public, making its founders rich without ever having made a single dollar in profit. The most legendary example was the Globe.com, a social networking site before the term existed. On its first day of trading in November 1998, its stock was priced at $9 a share. It opened at $87 and soared to a high of $97, a first-day gain of over 1,000% at its peak, before closing up 606%. The company's two 24-year-old founders were worth, on paper, nearly $500 million each. This wasn't investing, it was a lottery, and for a time it seemed like everyone was winning. Act 2. The Heretic of Omaha and His Unshakable Laws. While this financial supernova was expanding, Warren Buffett remained in his quiet corner of the universe, seemingly oblivious. To understand his profound skepticism,
You must understand the man and the unshakable intellectual framework he had spent a lifetime building, a framework forged not in a euphoric bull market, but in the harsh lessons of history. Buffett's philosophy began to form in his childhood. He was preternaturally obsessed with numbers and business. He read his father's investment books at the age of 7. He bought his first stock at age 11, 3 shares of Citi's Service Preferred for himself and his sister. He ran paper routes, sold chewing gum door to door, and installed pinball machines in barber shops, meticulously tracking his income and expenses. He learned early that a dollar earned was a real, tangible thing, not an abstract concept. His intellectual awakening came at Columbia University. He had initially been rejected by Harvard Business School. In a moment of despair, he discovered that his idols, Benjamin Graham and David Dodd, were teaching at Columbia.
He wrote to Dodd, "Dear Professor Dodd, I thought that you guys were dead, but now that I found out that you're alive and teaching at Columbia, I would really like to come." They let him in. He would later say that getting rejected from Harvard Business School was one of the best things that ever happened to him. At Columbia, he was a sponge. He was the only student to ever receive an A+ from Graham. He absorbed Graham's core teachings, that a stock was not a flickering symbol on a screen, but a fractional ownership of a real business, and the only rational way to invest was to first calculate the intrinsic underlying value of that business and then, and only then, try to buy it for significantly less than it was worth. This discount he called the margin of safety. It was the intellectual bedrock of Buffett's entire 6-decade career. Another of Graham's key ideas, which Buffett would quote for the rest of his life, was the parable of Mr. Market. He told his students to imagine they were partners in a business with a man named Mr. Market. Every day, this partner shows up and offers to either buy your share of the business or sell you his at a price he names. The crucial part is that Mr. Market is a manic depressive. Some days he's euphoric, gripped by greed, and his prices are ridiculously high. On other days he's panicked, consumed by fear, and his prices are absurdly low. Graham's lesson was simple. A smart investor doesn't let Mr. Market's mood dictate his own. He uses it. He happily sells to the euphoric Mr. Market and greedily buys from the depressed one. During the dot-com bubble, Market was not just euphoric, he was clinically insane, offering to buy businesses for hundreds, even thousands of times what they were earning. And so, Buffett simply refused to play. When Buffett took control of Berkshire Hathaway in 1965, it was a failing New England textile mill. He used the dwindling cash flow from that dying business to begin buying other, better businesses, applying Graham's principles with a new twist from his partner, Charlie Munger. Munger convinced him it was better to buy a wonderful company at a fair price than a fair company at a wonderful price. This led Buffett to seek out companies with what he famously called a durable competitive advantage, or a moat. A moat was a structural advantage that protected a company from competitors, just as a moat protected a medieval castle. Coca-Cola's moat was its brand, a name recognized in every corner of the globe. Gillette's moat was its dominant market share and the recurring need for its products. See's Candy's moat was the powerful, nostalgic connection its customers had to its chocolates. Another legendary purchase was Nebraska Furniture Mart, bought from its founder, Rose Blumkin, a Russian immigrant known as Mrs. B, based on a handshake deal. Her model was, sell cheap and tell the truth. This was a business Buffett could understand. It was simple, honest, and profitable. This was his circle of competence. He famously said, "We're looking for a 1-foot hurdle we can step over, not a 7-foot hurdle we can try to jump over." He admitted he had no idea if Yahoo or Lycos would be relevant in 10 years, but he was absolutely certain that people would still be drinking Coke, chewing Wrigley's gum, and reading the Washington Post.
This steadfast refusal to venture outside what he understood was seen as his greatest weakness in 1999. In reality, it was his greatest strength. while Warren Buffett was methodically building his fortress of tangible businesses. The prophets of the new economy were constructing a very different kind of empire, one built not on profits, but on promises. The language of this new era was intoxicating. Words like paradigm shift, synergy, and disruption were used to justify valuations that had no connection to any historical precedent. The old guard of Wall Street, men who had built careers on analyzing balance sheets and income statements, were either swept up in the frenzy or pushed aside. A new breed of momentum investor came to dominate the market. Their philosophy was simple: buy what's going up, and it will keep going up. The fundamentals of a company were irrelevant. All that mattered was the story, the narrative, and the most powerful narrative was the internet. A company that was losing hundreds of millions of dollars was not a failing business, it was investing in growth. A CEO who had never run a business before was not inexperienced, he was a visionary. This suspension of disbelief was not just encouraged, it was a prerequisite for participation. The culture of Silicon Valley began to merge with the culture of Wall Street in a toxic self-reinforcing loop. Young entrepreneurs in California would pitch ideas to venture capitalists. The VCs, flush with cash from previous IPOs, would fund these ideas. The company would then spend millions on advertising and marketing to build the brand, preparing for its own IPO. The investment banks on Wall Street, eager for the massive fees that IPOs generated, would then take the company public.
And the public, seeing every IPO soar on its first day, would clamor for more. It was a perfect perpetual motion machine of wealth creation, or so it seemed. This ecosystem produced some of the most absurd business models in corporate history. Take, for example, a company called Pixelon. Founded by a man who claimed to be a visionary video pioneer, the company threw a lavish launch party in Las Vegas in 1999, spending an estimated $16 million. They hired The Who, the Dixie Chicks, and even Kiss to perform. They promised to revolutionize video on the internet, but their technology never actually worked. It was later revealed that the founder was a convicted felon who had been on the run for years. The company collapsed, a perfect metaphor for an era where the party was more important than the product. Against this backdrop of chaotic, unrestrained speculation, Buffett's annual letters to his shareholders read like dispatches from another planet. In his 1998 letter, he wrote with his trademark folksy wisdom about the importance of understanding the difference between price and value. He said, "The stock market is a no-called strike game. You don't have to swing at everything, you can wait for your pitch." In 1999, the world was swinging at every pitch, no matter how wild. Buffett kept his bat on his shoulder. He and Charlie Munger even began to sound like grumpy old men. At the 1998 Berkshire Hathaway annual meeting, Munger famously said, "If you mix raisins with turds, they're still turds." It was his colorful way of saying that even if some dot-coms had a kernel of a good idea, the vast majority were worthless.
The audience of devoted Berkshire shareholders laughed, but Wall Street saw it as further proof that the two men from Omaha were simply out of touch. Act 3. The Collision Course. By 1999, the disconnect between Buffett's world and the dot-com world had become a chasm. That year, Berkshire Hathaway's book value grew by a paltry 0.5%. The S&P 500, by contrast, rocketed up 21%. It was the single worst year of underperformance in Buffett's entire career. The mockery reached a fever pitch. In July of 1999, Buffett was invited to speak at the Allen & Company conference in Sun Valley, Idaho. This was the exclusive annual gathering of tech and media titans. In a room filled with the very people getting rich off the bubble, figures like Bill Gates of Microsoft, Andy Grove of Intel, and Jeff Bezos of Amazon, Buffett delivered a speech that would become legendary. It was a masterclass in his way of thinking, part history lesson, part sermon, and part dire warning. He didn't talk about the internet. He didn't talk about technology. Instead, he took the audience on a journey through the history of other great, world-changing American industries, automobiles at the turn of the 20th century, and aviation in the 1920s and 30s. He presented data showing that at the dawn of the auto age, there were over 2,000 car manufacturers in the United States. Almost all of them went bankrupt. He asked the audience to imagine if they had known in 1900 which 3 companies would survive to dominate the industry. Even with that perfect foresight, he argued, it would have been nearly impossible to make money because the competition and the capital required to stay in the game were so intense. He then turned to aviation.
He pointed out that while the airplane was one of the most important inventions in human history, for the first several decades of its existence, the net profit for the entire U.S. airline industry was negative. Hundreds of airlines had gone bankrupt. His conclusion was devastatingly simple and a direct refutation of the new economy mantra: a revolutionary technology that changes the world does not automatically equal a profitable business for its owners. He was politely applauded and then largely ignored. Jeff Bezos, whose Amazon stock was then trading at a sky-high valuation, was reportedly unimpressed. Then came the Barron's article in December 1999. It wasn't just an attack. It was a symbol of the absolute consensus. The article detailed how Buffett had missed out on Dell, on Microsoft, on America Online, on the entire digital revolution. It ran charts showing Berkshire's dismal performance against the NASDAQ. It concluded that while he was a great investor for his time might have passed. For anyone questioning the new paradigm, this article was presented as the final irrefutable piece of evidence that they were on the wrong side of history. The mania continued to accelerate into the new millennium. On January 10, 2000, America Online, a company whose entire fortune was built on the screeching sound of a dial-up modem, announced it was acquiring Time Warner, the media behemoth that owned Warner Brothers Studios, CNN, and Time Magazine. The deal was valued at an astounding $164 billion. A company that was barely a decade old, with a fraction of the revenue and assets, was buying a titan of the 20th century.
The Wall Street Journal called it the deal of the new century. It was seen as the final symbolic triumph of the digital world over the old analog one. The CEO of Time Warner, Gerald Levin, called it a transformational moment, believing he was securing his company's future. In reality, he was selling the crown jewels for magic beans. 3 weeks later, the spectacle reached its pop culture apex at Super Bowl XXXV. It was dubbed the dot-com Super Bowl. 17 different dot-com companies, flush with IPO cash, spent fortunes on ads. Pets.com, with its charming sock puppet, was there. So was Epidemic.com, OurBeginning.com, and a host of other names now lost to history. They were spending money they didn't have to attract customers who weren't yet profitable in a desperate race to become a household name before their funding ran out. The cost of a 30-second ad spot was over $2 million. For many of these companies, that single ad represented a huge portion of their total capital. It was the ultimate speculative gamble. Meanwhile, Buffett was quietly writing his annual letter to Berkshire Hathaway shareholders. Released in February 2000, in it he was, as always, brutally honest about his own poor performance. He wrote, "Last year, we had the worst absolute performance of my tenure, and compared to the S&P, the worst relative performance as well. It is not pleasant to be that far behind." But he made no apologies for his strategy. He didn't promise to change. Instead, he calmly reiterated his belief in value, in profitable businesses, and in his refusal to participate in what he saw as a speculative frenzy. He wrote, "The lines separating investment and speculation, which is never bright and clear, becomes blurred still further when most market participants have recently enjoyed triumphs. Nothing sedates rationality like large doses of effortless money." He was a ship captain holding his course in a hurricane, lashed to the mast of his principles, while all around him, other ships were celebrating how fast they were being blown towards the rocks. The first 10 weeks of the year 2000 represented the final vertical ascent of the rocket before it ran out of fuel. The NASDAQ index, which had started 1999 at around 2,200, exploded, gaining another 24% in just over 2 months. The public's appetite for tech stocks seemed insatiable. Professional fund managers, even those who privately believed the market was overvalued, were forced to keep buying. This was a phenomenon known as career risk. If they sold their tech stocks and the market kept going up, they would lose clients and likely their jobs. It was safer for their careers to be wrong in a crowd than to be right alone. This period was defined by a complete detachment from financial reality. A company called VA Linux Systems, which sold computer hardware running the free Linux operating system, went public in December 1999. Its stock was priced at $30. On its first day, it soared to a high of $320, a gain of nearly 1,000%, before closing at $239. It was the most successful IPO in history. At its peak, this small, unprofitable hardware company was worth more than General Motors. Another company, Qualcomm, a pioneer in digital wireless technology, saw its stock rise an unbelievable 2,619% in the single year of 1999.
Its market capitalization swelled to over $100 billion, making it one of the most valuable companies in the world, despite having relatively modest revenues and earnings. This was the environment that gave birth to the day trader. Armed with a personal computer and an online brokerage account, ordinary people quit their jobs to trade stocks from home. They congregated in online chat rooms on Yahoo Finance and Raging Bull, sharing tips and hyping stocks. They believed that technical analysis, reading charts and patterns, had replaced the old, tedious work of fundamental analysis. They weren't investors. They were players in a global casino where, for a time, it seemed like the house never won. The mainstream media fanned the flames. Financial news networks provided a constant drumbeat of hype. Analysts who were bullish on tech stocks were celebrated as visionaries. Those who urged caution were dismissed as dinosaurs, much like Buffett. The cover of Time magazine in March 2000 featured a story on Amazon's Jeff Bezos, hailing him as the king of the internet. The entire culture was caught in a feedback loop of euphoria. While all this was happening, Buffett was making moves that to the outside world seemed almost perversely out of step. In late 1999, Berkshire Hathaway announced it was acquiring a majority stake in Mid-American Energy, a utility company based in Iowa. Utilities were the definition of an old economy business. They were slow-growing, heavily regulated, and deeply unglamorous. Wall Street was baffled. Why would the world's greatest investor buy a boring electric company when he could be buying the future of the internet? The answer was simple. Mid-American Energy had tangible assets, power plants and transmission lines. It had predictable, regulated earnings, and he was buying it at a fair price. It was a classic Buffett investment, a 1-foot hurdle in a world obsessed with trying to clear 7-foot bars. He was also stockpiling cash. By the end of 1999, Berkshire Hathaway was sitting on tens of billions of dollars in cash and government bonds. In a soaring market, holding cash is a cardinal sin. It means you're missing out on the gains. But for Buffett, cash was not a liability. It was an option. It was the dry powder he was keeping ready for the day when the fire sale would inevitably begin. He was following one of his most famous dictums. The first rule of investing is don't lose money. The second rule is don't forget the first rule. Act 4. The Great Unraveling. On Friday, March 10, 2000,
the NASDAQ index closed at its all-time peak of $5,048.62. And then, without any single dramatic event, the fever broke. The unraveling began not with a bang, but with a quiet, creeping dread. A few major tech companies, including Dell and Cisco, reported earnings that, while still showing growth, were not quite as spectacular as the superhuman expectations analysts had set. The Japanese economy, a major source of global capital, officially entered a recession, causing investors there to pull money out of U.S. markets. And on April 3rd, a federal judge ruled that Microsoft had violated antitrust laws, sending a shockwave through the tech industry's biggest and most profitable titan. These were the sparks, but the kindling was the simple, terrifying realization that had been dawning on investors. The profits were not coming. The promise that market share would magically transform into earnings was proving to be a fantasy.
The capital that had been so freely given by venture capitalists and IPO investors was finite, and companies were burning through it at an alarming rate with no path to profitability in sight. The sell-off started slowly, then accelerated violently. The week of April 14, 2000 was one of the most brutal in market history, with the NASDAQ plunging 25%. There were brief, panicked rallies with analysts and TV personalities declaring that this was a healthy correction, a buying opportunity for the true believers. They called this phenomenon a dead cat bounce, from the old Wall Street saying that even a dead cat will bounce if it falls from a great height. But the tide had turned. For the next 2.5 years, the market would be trapped in a brutal, soul-crushing decline. The carnage was absolute. Companies that had been worth billions saw their valuations fall by 90%, 95%, even 99.9%. Cisco Systems, a maker of internet hardware and a darling of the era, saw its market value plummet from over $550 billion to around $100 billion, wiping out more than $400 billion in market capitalization. Amazon.com, which would one day become one of the most valuable companies on earth, saw its stock plummet from over $100 a share to less than $6. Scott McNealy, the outspoken CEO of Sun Microsystems, a company once valued at over $200 billion, would later give a brutally honest assessment. He asked, "What were you thinking? At 10 times revenues to give you a 10-year payback, I have to pay you 100% of revenues for 10 straight years in dividends? That assumes I can get that by my shareholders. That assumes I have zero cost of goods sold, which is very hard for a computer company. Got 10 times revenues to give you a 10-year payback, I have to pay you 100% of revenues for 10 straight years in dividends. That assumes I can get that by my shareholders. That assumes I have zero cost of goods sold, which is very hard for a computer company. That assumes zero R&D, which is hard with 30,000 engineers. That assumes zero selling cost, zero everything. And you're paying 10 times revenues? What were you thinking?" The lesser companies, the ones built on pure hype, simply ceased to exist. Webvan, the online grocery delivery service that had raised $375 million and was once valued at $1.2 billion, declared bankruptcy in July 2001. It had burned through its cash building a massive, unprofitable network of state-of-the-art warehouses and a fleet of delivery vans. Cosmo.com, which promised free one-hour delivery of anything from DVDs to ice cream in major cities, burned through $250 million and went bust in April 2001. And then there was Pets.com, the ultimate symbol of the era's excess. The company liquidated in November 2000, just 9 months after its celebrated IPO, having burned through over $300 million of investor capital. Its business model, it turned out, involved selling 50-pound bags of dog food at a loss and then paying to ship them across the country. Its famous sock puppet mascot was sold in the bankruptcy auction. The human toll was immense.
The day traders who had quit their jobs were wiped out. The ordinary families who had poured their savings into tech funds saw their retirement dreams vanish. In Silicon Valley, the Porsches and Ferraris that had filled the parking lots of startups were repossessed. The lavish parties came to an abrupt end. The entire culture of instant, effortless wealth collapsed in on itself. By October of 2002, the NASDAQ finally hit its bottom at 1,114. It had lost 78% of its value from the peak. An estimated $5 trillion in wealth had been vaporized. The new economy was dead. And what of the dinosaur in Omaha?
While the digital world was experiencing its own private Great Depression, Warren Buffett was in his element. The manic Mr. Market was now in the depths of a profound, suicidal despair, willing to sell wonderful businesses for a fraction of their worth. And Buffett, having patiently sat on a mountain of cash, went shopping. He was not buying the battered .coms. He was sticking to his circle of competence, buying wonderful businesses that had been unfairly punished in the market-wide panic. His moves were deliberate, calculated, and brilliant. The patience he had shown for years was not passivity. It was the act of a predator waiting for the perfect moment to strike. He invested in companies that were the antithesis of the new economy. He bought up utilities and pipelines through his acquisition of Mid-American Energy, a boring but stable business that generated predictable cash flow. He bought manufacturing firms like Shaw Industries, the world's largest carpet manufacturer. He bought building materials companies. These were the businesses that built the physical world, the very things the new economy prophets had declared obsolete. He made a huge and hugely successful bet on the Chinese oil company PetroChina, investing $488 million in 2003. Wall Street was skeptical, but Buffett had done his homework. He read the company's annual report, calculated its value, and determined that a business worth $100 billion was being offered to him in the market for only $35 billion. It was a classic Buffett investment. When he sold his stake a few years later, he walked away with a profit of $3.5 billion. He was following his own famous advice to the letter: be fearful when others are greedy, and greedy when others are fearful. The world was now terrified, and Warren Buffett was getting greedy.
The numbers of his vindication were as staggering as the numbers of the collapse had been. As the S&P 500 languished for years after the crash, Berkshire Hathaway's stock began its steady, relentless march upward. The boring businesses, the insurance, the candy, the razors, the soda, continued to generate billions in cash, which he then reinvested with masterful skill. The Barron's article that had questioned his relevance became a legendary contrarian indicator, a perfect sign that the market had reached its peak of insanity. The AOL-Time Warner merger, once hailed as the deal of the new century, became known as the worst merger in corporate history. The promised synergies never materialized. The culture clash between the aggressive, fast-moving .com employees and the staid, established media executives was catastrophic. In 2002, the company posted a loss of nearly $99 billion, the largest annual loss ever recorded by a company at the time, mostly due to writing down the value of the AOL acquisition. The final, humiliating nail in the coffin came in 2009, when Time Warner spun off the withered remains of AOL for a tiny fraction of its former value. The great symbol of the new economy's triumph had ended in total, abject failure. Steve Case, the CEO of AOL, who had orchestrated the deal, became a pariah. Gerald Levin, the Time Warner CEO who had agreed to it, would later call it the worst decision of his life.
Henry Blodgett, the star analyst who had put a $400 price target on Amazon, was eventually banned from the securities industry for life after an investigation revealed that he was privately emailing colleagues calling the stocks he was publicly recommending pieces of junk. He later found a second act as a financial journalist, often writing about the importance of the very value principles he had once dismissed. Warren Buffett, of course, never gloated. He never said, "I told you so." He simply continued to do what he had always done: read, think,
and patiently wait for opportunities to buy good businesses at fair prices. He would go on to make some of the greatest investments of his career in the decades that followed, including a legendary $5 billion investment in Goldman Sachs during the depths of the 2008 financial crisis, another period of profound fear where he once again acted with decisive greed. When the world was panicking, they turned to the one man who had proven he could remain sane. The dot-com bubble, for all its destruction, did lay the groundwork for the real internet economy that would emerge from its ashes. Companies like Amazon and eBay survived and would go on to become profitable behemoths. Google, founded in 1998, wisely waited until 2004 to have its IPO after the bubble had burst and sanity had returned to valuations. The lesson wasn't that the internet was a fad, it was that the eternal laws of business still applied to it. A company, no matter how exciting its technology, must eventually generate a profit to be worth anything. The story of Warren Buffett and the dot-com bubble is more than a story about money.
It is a timeless fable about the conflict between wisdom and hype, between patience and greed, between reality and illusion. It proved, in the most dramatic fashion possible, that the fundamental laws of business are like the laws of physics. They can be ignored for a time, they can be defied, but they cannot be broken. Eventually, gravity always wins. The new economy prophets believed they had built a machine that could fly to the sun. Warren Buffett was the old engineer who quietly reminded them that wings made of wax have a fatal, predictable flaw. The pundits laughed at his old-fashioned stocks until the bubble burst and the harsh, unforgiving light of reality showed everyone what real investing was and always will be. It's not about chasing fads or predicting the future. It's about understanding the simple, unchanging mathematics of value, a lesson that the market teaches again and again to every generation that dares to forget it.